So, what's the US data telling us and the market action? We are joined by two experts, Bob Doll, Chief Equity Strategist at Nuveen Asset Management, and George Marsical, the Regional CIO of Emerging Markets at UBS. Good evening, I would say, to both of you gentlemen. Thank you for joining us all the way from New York and staying up for us. Bob, first to you. Of course, we've seen this big bounce back in the mother market, in the US equity markets. But as we were just discussing, has the fundamental terrain changed? Are we still now looking for a lower global growth than we did in the first half of 2015? And hence, will equity markets struggle to reach previous highs?
Well, it's going to take some time. I think this last week is, frankly, less about fundamentals and more about technicals. We had the sell-off that was caused by lots of fundamental concerns for sure, but the pace of selling and the rapidity of it was exaggerated by forced selling on the part of some momentum traders, and the selling begat selling and some dislocation. Now we've had a bounce back. Typically, you get a rally after a big sell-off like that, but then you have to go back and test to some degree, and my guess is we will see more volatility and head back down at some point in time. The ultimate resolution will depend on economic and, more importantly, earnings growth, and things on that score continue to improve in the United States.
Okay, but the GDP data from the US is giving you the impression that US is better off than you thought previously?
Yes, I think that's fair to say. I would say the U.S. economy is broadening. Consumers are spending and capable of spending some more money. The job growth's been pretty good. Obviously, there's been a decline in interest rates, a further decline in energy prices, notwithstanding the bump up we saw today. And that means consumers have more discretionary income. Their confidence level will determine how much of that they spend, and I think they will spend some of it. And corporate earnings, after falling in expectation format in the first part of this year, are beginning to move back up a bit, and I think we'll see more of that into the back part of the year.
Okay, let's get the point of view from the emerging market CIO. George, good morning. What's your sense? Do you think we've seen the worst of equity markets, or is this going to turn out to be a counter-trend rally which will be sold into, especially in emerging markets?
I think the sell-off that we saw before had not very strong fundamentals behind it. So I'm with my colleague who just spoke, who believes it was more of a technical move. I do tend to agree. I think the downside that we saw, the correction we saw, was more driven by, thin volume and momentum-driven trades outside of and a bit of a growth scare as well, but I think not justified by the fundamentals. I would say, regarding China, the stock market is a sideshow. I think the real issue is the exchange rate and what's going to happen with this renminbi going forward. I think the major change, and the one that everybody's scratching their heads about, is the valuation of the renminbi, which so far has been only about 3%, but could be significantly more than that if the economy of China does not recover. So I would say that is where the real stakes are.
Okay. So George, in that case, how would you bet your money on in emerging markets? Would you not buy any of the commodity markets just yet, or even the commodities, in anticipation that you're going to have weakened demand from China? Is the commodity bounce back also a dead cat bounce? Yes,
I think for the foreseeable future, commodities are going to probably be at best moderate in their performance. So, in our global portfolio, we continue to recommend an underweight in emerging markets. That is, we have a negative position on emerging markets, broadly speaking, partly as a result of China, but also partly as a result of growth in other emerging markets related to commodities and the lack of structural reform. There are a few countries that are doing better, and we do like those. There are opportunities. India is among the ones that we think stands to suffer least from the Chinese volatility, and where the reform momentum still remains quite strong. So India, Taiwan is more tied to the U.S. tech cycle rather than the Chinese cycle. And we also like, outside of the Asia complex, we also like Turkey, which has been unfairly punished by political risk, and we think it benefits from low commodity prices.
Okay. Bob, what's your sense? Do you think this equity market rally is going to continue, and what we have seen over the last fortnight is just an aberration?
No, I think the way I put it is the selling pressures began to abate. I mean, there was awesome amounts of selling with big volume and big downward moves, and that selling exhausted itself, and there's some confidence that's coming back to some degree. We saw some of the yield curves move back up, giving more confidence. I think people are recognizing that the planet is not strong in its growth, but it's not weakening either, aside from some countries. And with fixed income, with interest rates fairly low, equities are backed into as an asset of choice, and some people are doing that. Lots of people have lots of cash on the sidelines waiting a pullback, and we got the pullback, and maybe some of them put some to work. So I repeat what I said earlier. This last trading week has been a lot about technical moves, less about fundamental ones.
No, I take your point on that, but now that you've got also good fundamental data in the form of the GDP number or the durable sales or home sales, should the market expect anything at all from the Fed on 17th of September, Bob?
Great question. My view all along has been the Fed has waited too long to begin to move rates up, simply because their starting point is zero. Now they face a dilemma. Do they, in the face of all this consternation and volatility, make that first move to the upside? The probabilities, as you know, according to the yield curves, have moved from above 50% to less than 50%. I guess if the move to the upside continues and the dust settles and things calm down, they may go back and sharpen their pencils and raise rates. But I think given the dovishness of this Fed, they are more likely to wait.
Oh, and George, what would your view be?
I think there is it's a toss-up between September and December. I think the more important question is how much more will rates rise after the first rise. And, I think the world is ready for the beginning of normalization. I think it's the most awaited change in Fed policy, I think, in history. So I don't think it's going to be a big debacle if they raise rates in September. I think the most important question, the more important question is the path of interest rates going forward. And I think that on that front, what I conclude, given the balance of data and the risks in the global economy, is that the Fed is going to go very slowly. So that might rate 25 basis points this year, maybe another 75 basis points next year. But at the end of 2016, I think it's unlikely that we're going to be higher than 1.5% in the Fed funds rate. So we're going to go slow.
Oh, yes. And I think that was made amply clear by the Fed, that it will not be a start of a continuous set of rate hikes. Thank you very much, Bob and George, for joining us this evening. Okay, morning for us, but I think the key takeaway is that this was largely a technical gyration in the market, according to Bob. So he's not reading too many fundamentals into it. And I think what we heard from George would be heartwarming, that after the flood and the ebb, in the debris, India stands out even better, because it looks like commodities are an even more weakened lot. China is definitely a question mark. So that leaves you a slightly cleaner shirt in this very difficult laundry.
Yeah, I think the big